Good morning, Trader First Year. This is the 3/8/2021 morning forecast. Markets are implying a move of 1.72% up down on the S&P 500. Markets have realized a move of 1.06 up down on the S&P 500. The difference between what market makers are implying and what has been realized has tightened. The spread increased 10 basis points. The put-call gamma imbalance is skewed towards short-dated calls on dip buying. However, a widening of spread increases left tail risk and the potential for delayed upside spikes in realized volatility. Realized volatility has increased recently above 16. This is favorable for wider and larger moves up, down on the index. However, rising growth or inflation expectations without rising inflation or growth are pushing up real yields, which is creating equity long duration valuation conflicts and raising discount rates. The S&P 500 is expected to move close to 2.31% this week, which means the S&P could decline 7 to 9% above its 200-day moving average, which is 3,471.53. The S&P is currently trading very close to its 50-day moving average, which is 3,821.99. Full-year S&P earnings are expected to total 174 per share. At current prices, this puts the S&P 500 at 22 times earnings, which equates to an earnings yield of 4.5% and a real earnings yield of 2.5%. Forecasters are expecting nominal growth of $300 billion and real economic output of $130 billion for the first quarter of 2021. Full-year economic output estimates have increased following passage of stimulus. Medium forecasts were anticipating close to $1.2 trillion in nominal growth and $800 billion in real economic output for 2021. Economists continue to place the highest expectations for growth in the second quarter of 2021. Investment banking professionals are forecasting nominal growth of $400 billion and real output of $240 billion for the second quarter. This is a substantial amount of spending on goods and services, which may fail to materialize if there are any delays in COVID vaccinations or rollouts. Under these assumptions, we need $50 to $60 billion of spending on personal consumption expenditure in April, May, and June. I think these estimates are optimistic, and I continue to rely on more conservative estimates. I think we could see nominal growth in the second quarter of $325 billion to $350 billion. Real output is likely to be between $180 billion to $210 billion. There is a strong possibility the $1,400 stimulus checks increase consumption similar to economic data in January of 2021, which recorded a $357 billion gain in personal consumption expenditure. I may upgrade my forecast following the additional data releases. Despite a strong, robust payrolls number in March, the trend has been weak non-farm payrolls growth and elevated numbers of Americans receiving some form of unemployment assistance, which indicates large swaths of slack in the labor market. This key economic indicator is likely to pressure growth in the first half of 2021. However, recent agreements on a $1.9 trillion in deficit spending is significant tailwind to nominal growth in the second half of 2021 and first half of 2022. This assumes virus cases continue to come down substantially by April, May, and pandemic flare-ups lessen. This has led some market observers to anticipate economic overheating, which is favorable for upside risk in inflation. I believe these fears are statistically unfounded. The recent increase in nominal Treasury yields and 5-year break-evens on tips towards 2.45% is transitory and likely reflecting recent increases in energy prices and base effects. Following the passage of stimulus, larger fiscal savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the US dollar and downward pressure on corporate and government bond yields. Potentially weaker inflation data than consensus estimates should allow real yields to remain negative. Dollar appreciation dampens import commodity-driven inflation and should lessen temporary transitory base effects. Inflationistas, inflation fearmongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to be led to short-term transitory spikes in inflation data February, March, April, and May. Market expectations are still split, but I expect the Federal Reserve will look through these spikes. Political risks have diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and the first half of 2022, which may pose risk to much-needed investment spending on infrastructure, human capital, and research and development. So I view it in the medium term as tilted to the upside due to potential gridlock. However, there is the possibility for removal of the filibuster rules in the Senate, which could pave the way for easier passage of additional investment-led spending, which is much needed to raise the U.S. long-term potential growth rate. Although due to political isolation, this increases the potential upside of lone wolf domestic terrorism. Vaccine distribution priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm, so instead of a fully vaccinated population, we may accept a different goalpost for the full vaccination. Details are currently unknown. The market is currently pricing an additional 3.27% move up or down by March 19th. The S&P 500 could potentially trade as high as 3,961.33 and as low as 3,741.43 by March 19th. The VIX is expected to move 7.29%. The VIX is currently 27.38. The VIX price range is 29.37 to 25.51. The skew index is extremely elevated, which indicates market participants are paying up for catastrophic protection 2 sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.5%, while the nominal yield on 10-year treasuries is 1.6%. Real yields on all tenors of government bonds at the shorter end and the belly of the curve are decisively negative, but real yields at the longer tenors above 20 years have moved into positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility rising above 12, there is a large risk of systematic highly leveraged short vol strategies like equity vol targeting, trend following, risk parity, position for a sell-off, and reduction in market exposure. The potential for much larger delayed sell-off, 4% or 5%, is coming. The March-April VIX contracts at 25 and 27 are still underpriced. They should price near 39 to 47 in my humble opinion. I strongly believe March 2021 could see a continued rise in realized volatility and implied volatility. However, I have been wrong before. In additional addendum to this, the repo market, the 10-year continues to trade on special. CFTC data indicates substantially large short interest. This is creating large fails to deliver. Treasuries, which has increased the 10 years Treasury specialness in repo markets. It now trades near a negative 4.25%. Broker-dealers, which are usually primary counterparts to the Federal Reserve and U.S. Treasury, are willing to accept a 3% fails charge, as supply of the new 10-year will be issued this week. The supply is for $38 billion, which the Federal Reserve will be able to purchase and relend as part of its SOMA securities lending program. However, with $68 billion of fails recorded last week, this number is likely to increase, which means the new supply of 10-year treasuries will not likely satisfy current outstanding demand. This will leave the 10-year treasury trading negatively in the repo market. However, institutional holders, ETFs, and foreigners may see this as a great opportunity to take cash, lend collateral, and reap substantial benefits by investing the proceeds in higher yielding assets. The story will likely be covered extensively following the new issuance on Wednesday. Thanks for following.